Good morning, everyone. Hope you're being well. Warm greetings from the KPMG team in Oman. I'm Ashok Hariharan. I lead the tax practice for KPMG in Oman. I will moderate today's webinar, which focuses on the hospitality sector. Before I continue, a few administrative matters. You may key in your questions through the Q&A tab, which will be seen only by the panelists. You can also send your questions through the normal chat box, which everybody can view. We will address your questions during the Q&A session. Please do not wait for the presentation to end to post your questions. After the webinar, please do take a minute to complete the feedback survey. Your comments are always valued. Finally, as is the practice, this session will be recorded. I'm sure you all are very busy running against time to get ready for the VAT go live date of 16th April 2021, which is now only a month away. You may be aware that the tax authority issued the much awaited executive regulations in Arabic yesterday. We are reviewing these regulations and will keep you updated. We have had 3 very interactive seminars last week focusing on the manufacturing, retail, and transport and logistics sectors. After today's hospitality webinar, we will be covering this week the real estate, healthcare, and oil and gas sectors. This will be followed in the subsequent week by the power and utilities and the financial services sectors. Let's look at the agenda for this hospitality webinar, which we expect will take about an hour. After my introduction, we will provide you with a status update on the VAT implementation. We will take you through the Oman VAT framework and then deal with specific issues for the hospitality sector. As you are aware, this sector is vital for Oman's tourism, which is an important priority area for the government's diversification agenda. This has indeed been reiterated in Oman's Vision 2040 document. Some of the hospitality sector issues which we intend covering include matters such as what is the VAT treatment for tourism fee, municipality fee, and service charges? How do you treat vouchers such as those issued for hotel stays or shopping? What about loyalty programs? How does the time of supply rules apply to advance payments, credit card guarantees, and no-shows? How does reverse charge apply on services from international partners or vendors? Apart from understanding VAT issues, you also need to make sure that your IT systems understand the Oman VAT requirements. What changes do you need to incorporate in your ERP to not only deal with the day-to-day transactions, including raising VAT compliant invoices, but equally important, to generate the reports that you would require in order to report to the tax authority. After the IT considerations, we will identify the next steps for you to be ready for the VAT go live date. I'm pretty sure businesses will get there as they did in Saudi Arabia, UAE, and Bahrain, despite many challenges they would have to deal with. However, please remember that the go live date is not the sole objective. You need to be confident that your VAT implementation stands scrutiny later by the tax authority, and you have the support of your strong advisors who can help you engage with the tax authority. You would also need to take into consideration new clarifications, guidelines, which are bound to be issued as both businesses and the tax authority settle into the new VAT era. We continue to be engaged with the tax authority for our clients' benefit. In order to take you through all these topics, we have a distinguished panel of VAT specialists. We have Aba Lekak, who hopefully is a familiar face having been in Oman for the last 3 years. She is now a partner in our tax practice. She has not only helped us establish a strong indirect tax practice to complement our well-recognized corporate tax practice, but has also been playing an important role in sharing insights on VAT to businesses and the tax authority based on her experience in the GCC states and also India. We are supported by Rob Dalla Costa, a very experienced senior advisor who has spent his last 5 years in the GCC region, including Oman. Rob has worked closely with us during a long engagement with the tax authority to assist them with the design of the VAT system, including drafting of the VAT legislation. Lastly, we have Julie, who is not only a VAT specialist, but equally important, a tax technology specialist. She has been helping a number of businesses in Oman upgrade their ERP systems to deal with the Oman VAT legislation. I will now request Abad to give the status update and take us through the Oman VAT framework.
Thanks, Ashok. So the VAT law was published on the 18th of October 2020. Takes effect 180 days from the date of publication, which is why we go live with VAT on the 16th of April 2021. In January this year, the tax authority issued 3 decisions, of which 2 are on registration and 1 on the zero rating of 93 food items. One of the decisions on registration reiterates the monetary threshold for mandatory as well as voluntary registrations. Mandatory registrations for businesses with supplies in excess of 38,500 Omani Riyals per annum. Voluntary registrations for businesses with supplies or expenses in excess of 19,250 Omani Riyals per annum. The other decision on registration staggers the registration and go live, similar to Bahrain, but different monetary threshold. So businesses with annual supplies in excess of 1 million Omani Riyals must register with effect from 16th April 2021. And the due date for registration is today. 500,000 to 1 million Omani Riyals will be effective from 1st July 2021. 250,000 to 500,000 Omani Riyals from 1st October 2021, and 38,500 Omani Riyals to 250,000 from 1st April 2022. Businesses eligible for voluntary registration may apply at any point in time. And there are different registration processes for resident businesses with commercial registration, resident businesses without commercial registration, and non-resident businesses. The monetary threshold, of course, does not apply for non-resident businesses liable for registration in Oman. The portal allows registration of tax groups, but in order to create a tax group, all members of the tax group must first be registered independently. Now, while the law sets out the framework, as they say, the devil lies in the detail, and the detail on several substantive as well as procedural aspects are now set out in the regulations that were issued in Arabic yesterday. The unofficial English translation of the regulations is currently awaited and will follow from the tax authority in due course. The tax authority is also working on general and sector-specific guides to allow businesses better guidance, and these guides will also follow in due course. At the moment, there is clarity awaited on some notification or approval processes, deferral on import VAT, simplified billing, exemption from registration for zero-rated businesses, pre-registration input tax credit, and we're expecting that also to come through in due course and hopefully before go live. So that's a gist of where we are at this point in time. Now on to how Oman VAT will work once it goes live. If we go on to the next slide, we see the basic structure of VAT. What is value-added tax? As the name suggests, value-added tax is a tax that is charged on the value added at each stage of the supply chain. The supply could be that of goods, supply could be that of services, but as an indirect tax, this is intended to be borne by the ultimate customer. The business is only acting as an intermediary in the entire supply chain, collecting and depositing the tax on behalf of the tax authority, on behalf of the customer. It's not supposed to be a tax or a cost for the business unless the business is a business that is engaged in exempt supplies. And we'll see some examples of exempt supplies in due course. Globally, VAT is also known as Goods and Services Tax and is currently applied in 169 countries. In the GCC, this is a recent phenomena, but we've seen UAE and KSA implement VAT from the 1st of January 2018. We had Bahrain follow suit and implement VAT from the 1st of January 2019. So in the GCC, Oman is the fourth country to have introduced VAT. And it's quite similar to the VAT, the way it operates in the EU, in the sense that it is a unified tax that is intended to apply to multiple countries that form a part of a union. If you see the history of VAT, it was originally introduced in the 1950s and has evolved since then. In the GCC, this is levied under the auspices of the GCC Framework Agreement, which sets out the principles that are adopted by all the GCC countries, which are now implementing VAT under the local legislations, that is the law and executive regulations that are issued by each country. If we move on to the next slide, we'll see some of the concepts which are fundamental to VAT in any jurisdiction. And while we'll not go through each of these in details, we're hoping that 30 days away from implementation, most of you are familiar with these concepts, but we will just quickly touch upon them so that we are able to appreciate the issues in the hospitality sector better. We've already discussed registrations. It's important to understand supplies because VAT is applied on the supply of goods, supply of services. Usually you would expect that for a supply, there has to be a supplier, recipient, consideration. But in certain circumstances, even in the absence of this, VAT may apply by virtue of a deeming fiction. These are instances referred to as deemed supplies, and we'll touch upon these in a few slides. Time of supply is important for you to understand when your obligation to pay VAT arises. Place of supply is important for you to understand which jurisdiction are you liable to pay VAT in. Value of supply, to understand what value you should be paying VAT on. It's not necessarily just the monetary consideration that you receive. In certain instances, there could be additions, there could be exclusions, and you need to understand what is the tax base so that you ensure that you don't short pay or overpay your taxes. Reverse charge, as the name suggests, is a charge which is reversed because VAT is usually applied on the supplies and is the responsibility or obligation of the supplier. But in certain instances, the charge is reversed, and instead of the supplier having to pay or discharge VAT obligations, it is the recipient who needs to pay or discharge VAT obligations. This is usually in the case of import of goods, import of services, when your supplier is not registered for the purposes of VAT in the country. Input tax credit is an important part of the VAT regime because in order to ensure that VAT is only levied on the value added in each leg of the supply chain, it's important to have a mechanism of input tax and output tax. There are certain restrictions that apply to input tax availment, which we will deal with in a few slides from now, and then compliance obligations. So if we go on to the next slide, we'll see the different types of supplies that exist. Now, these are the basic types of supplies: standard rated, zero rated, and exempt. And as you can see, standard rated is where the supplier charges VAT at the standard rate. In Oman, it is expected to be introduced at 5%. And because there is a charge of VAT on the supply, the supplier is also eligible to recover the VAT charged by the vendor on purchases of goods or services used to make that supply. Zero rated supply, an extension of taxable supplies, is where the supplier charges a VAT but at the rate of 0%. And because there is a charge of VAT, the supplier is eligible to recover input VAT incurred on the purchase of goods or services used to make that supply. Exempt supply, different, although it does seem similar to zero rating. But what exempt supply means is that the supply is exempt from tax. And because it is exempt from tax, the supplier will not charge an output VAT. Because the supplier will not charge an output VAT, any cost or any VAT that is incurred on the purchases will become a cost to the supplier. So it's often common to confuse between zero rating and exempt, but exemption is a cost to business because the input tax credit is not available. If we move on to the next slide now, we'll see what qualifies for exemptions and zero ratings under the Oman VAT law. The Oman VAT law, along with the executive regulations now, also spells out instances of VAT suspension and transactions which would be treated as out of scope for the purposes of Oman VAT. But if we look at the entire list here, what's critical to see in exemptions is local passenger transport, which is exempt from VAT, and the conditions or what qualifies as local passenger transport is set out in the executive regulations. If we look at what qualifies for zero rating and is relevant to the sector, supply of food items. As I mentioned earlier this year, the tax authority has issued a list of 93 food items that would be eligible for zero rating. Zero rating is also extended to international transport of passengers and supply of services in relation to international transport of passengers. There is a zero rating also extended to supply of qualifying means of transport. There are other zero rating provisions, but some of them have limited application or relevance to this industry. So we'll move on to the next slide. If we look at this slide, it summarizes what instances could qualify as deemed supplies. As I mentioned earlier, in order for a transaction to qualify as a supply, you would usually expect there being a supplier, there being a recipient, there being a consideration, and there being a provision of goods or services between the supplier and the recipient. But in certain circumstances, these fundamentals may not exist, but the transaction may still attract a VAT and may still deem to be a supply for the purposes of VAT. Now, the basic premise for any transaction to qualify as a deemed supply is that the business should have recovered VAT that is charged by the supplier on the goods or services used for making such supplies. If the supply of goods or services is made free of cost or without consideration, it would be considered as a deemed supply. If the goods or services are purchased for making taxable supplies, but eventually applied for making non-taxable supplies, it would qualify as a deemed supply. Or if these are purchased for business, but then applied for non-business or non-economic or a purpose other than the economic activity, these would qualify as deemed supplies. What does it mean for a business if a transaction qualifies as a deemed supply? It means that either you need to charge VAT on the supply, even though you're not receiving a consideration for it, or you need to forego the input tax credit that you've recovered on the goods or services that you've used to make these supplies. If we move on to the next slide now, we deal with time of supply. At what point in time does a business need to pay VAT? Now, the general rule is that VAT needs to be paid at the earliest of the date of supply, the date of issuance of the tax invoice, or the date of receipt of payment. In certain instances where there's periodic payments or periodic invoicing, which is continuous supplies, the obligation to pay VAT arises at the earliest of the date of payment specified in the tax invoice or the date of payment itself, whichever is earlier. When we're making imports, the general rule under the Oman VAT law is that at the time of import of goods, VAT would have to be paid at the time of customs clearance in cash upfront. But the Oman VAT law also allows businesses and importers to apply for a deferral from the tax authority, where instead of having to pay VAT at the time of customs clearance, you can request to pay this at the time of filing the return. What that would mean is that you would show import of goods as an entry on your return. You would show the VAT payable again as an entry on your return, and you would claim input tax credit to the extent it's eligible on the return itself. So at the end of the day, it becomes a entry for you. It does not create a cash flow impact for you, unlike it would if you had to pay VAT in cash upfront at the time of customs clearance. The executive regulations now also set out the time of supply for supply of vouchers. they make a distinction between supply of specified vouchers and supply of non-specified vouchers. Specified vouchers are where you know what goods or services can be redeemed or exchanged in exchange for the voucher. And non-specific vouchers are where you don't know, or the use of the voucher is not known at the time of supply of the voucher or issuance of the voucher. In case of specific vouchers, the date of supply is the date of issuance or sale of the voucher. In case of non-specific vouchers, the date of supply is the date of redemption of the vouchers. If we go to the next slide, we deal with the place of supply rules, which help us understand what jurisdiction has the right to tax a particular transaction. We've already dealt extensively with supply of goods in the sessions that we've had earlier on in case of retail and manufacturing. But essentially for goods, where the supply is with transport, it is where the transport originates. In case of supply of goods without transport, is where the goods are made available to the customer. There are special rules for supply of oil gas, which will be dealt with when we have a session on oil and gas later this week. There are special place of supply rules for supply of services. Now, for the purpose of VAT, anything that is not a transaction of supply of goods or anything that does not qualify as goods qualifies as services. And these could be actively provided, these could be passively provided. What I mean by passively provided is the act of tolerance or the act of abstaining from doing something in exchange for a consideration can also qualify as a supply of service. And we'll see how that impacts the industry in case of no-shows, in case of cancellations, when Rob deals with the sector-specific issues. But the general rule for supply of services is that where the supply is made to an unregistered customer in the GCC, the place of supply is Oman. In all other cases, the place of supply is the place of residence of the customer. It's also important to make note of the special cases or the special place of supply rules, which apply to specific circumstances. What's most relevant for this industry is restaurant, cultural, or sporting event related place of supply rules, where these are deemed to have taken place in the country where the service is actually performed. So there are other special cases also, but some of them are of limited relevance to this industry. And we can move on to the next slide, where we deal with input tax recovery, which is integral to the entire mechanism of value-added tax. If you look at the law as well as the executive regulations, input tax recovery is allowed where the goods or services purchased are used or are intended to be used for making either a taxable supply, that is a standard rated supply or a zero rated supply, or for making an exempt supply outside Oman. Now, the input tax can be recovered only by a registered person and can be recovered only on the basis of a valid tax invoice or other documents which may be listed or which are specified in the executive regulations for availment of input tax credit. Input tax can be recovered for up to 3 years from the end of the tax period in which the right arises, which is quite liberal considering some of the other jurisdictions in the GCC. And in certain circumstances, the Oman Vat law and the executive regulations also allow businesses to recover input tax on goods that are lost, stolen, or damaged, but subject to approval of the tax authority and a particular procedure being followed. It also allows businesses to recover input tax on samples of up to a certain value per recipient, as well as total samples issued during the entire year. Input tax credit is blocked on certain types of purchases. Two categories: one where trade in these goods is prohibited in Oman. The other category is a list of or a negative list of expenses, which is set out in the executive regulations, largely revolves around expenses which are in relation to food and beverages, expenses in relation to motor vehicle that is available for personal use of employees or for non-business purposes, and expenses that are incurred for entertainment purposes. So those are the restrictions on input tax credit. In certain circumstances, you're required to adjust input tax, bad debts, discounts on purchases. The executive regulations do allow businesses to recover input tax on purchases that are made prior to registration. And that will be critical in Oman because registration is on a staggered basis. Some businesses may not register on the 16th of April. They may be due for registration on the 1st of July, 1st of October, or even as late as 1st of April 2022. So there is a mechanism for them to recover pre-registration input tax credits, but there's a procedure and conditions attached to it. If we move on to the next slide, it's on compliances. Every person who's making a taxable supply and is registered will need to issue tax invoices. You may issue invoices in foreign exchange, but you will need to have additional details put on it. In certain circumstances, you are eligible to issue simplified tax invoice. So they do not have all the contents required on a detailed tax invoice, but again, subject to conditions, subject to approval by the tax authority. Businesses would need to retain their books and records for real estate for 15 years and in all other cases for 10 years. Returns are required to be filed. Initially, all taxpayers are put on a quarterly tax return. So the return for the period 16th April to 30th June becomes due on the 30th of July 2021. Subsequently, the tax periods may change. Taxpayers may have the option of applying for a different tax period, but that will happen in due course. That option is not available at this point in time. You will have the option of revising your returns up to 3 years from the date of the submission. There are also provisions made for refunds, and in case of what's applicable to the sector, there will be refunds which will be extended to tourists, but again, subject to conditions and subject to the procedure being put in place. With that, I will pass this on to Rob and ask him to walk us through issues that are specific to the hospitality sector. Rob, over to you.
Thank you very much, Abba, for that summary. So I'm going to touch on some of the key issues, questions that you should be considering as you prepare for the VAT's introduction in just over 30 days from now. These are general observations, and obviously you should review how these might apply to your specific circumstances. So have a look at disclosed and undisclosed agency. This is a really key principle that many people operating in the industry need to understand. Article 19 of the VAT law notes that if an agent is making supplies in the name of the principal, then the principal is responsible for the VAT obligations of that supply. But if the agent does not disclose that they're acting for a principal, then they need to account for the VAT on the supply. So as I said, this has significant implications on who is liable for the VAT, who needs to report the VAT on their VAT return, whether it's the agent or the principal. So if we take the example of, say, a hotel making a booking for a guest for a tour in Oman, the hotel generally does not hold itself out as providing the tour. So the funds that it receives are not for a supply by the hotel, but they're for a supply by the tour operator. The hotel may withhold some funds from the operator as their commission for arranging the booking. Here, the hotel should issue a tax invoice for its commission to the agent, and it's just the commission revenue that the hotel needs to report. Equally important is identifying who is supplying the hotel accommodation, the hotel operator or the hotel property owner, as the two are often very different. So usually the hotel operator is the one who issues the invoice in their name, the name of the hotel, whether it might be the Marriott or the Grand Chancellor or something like that, and not that of the hotel owner. So as an undisclosed agent, it may be required to account for the VAT on the accommodation of all the revenue that it collects. This then brings me to another thorny issue, the VAT treatment of tourism fees, municipality fees, and the service charges. We find all these on the bottom of our bills, whether we stay for accommodation in a hotel, for example. As a general principle, if the charge is levied on the guest and it's only collected by the hotel, then this should be treated as a disbursement and not subject to VAT. If, on the other hand, the charge is levied on the hotel and the hotel chooses to pass it on as a separate charge to the guest, then this forms part of the taxable service that's being provided by the hotel. So VAT applies to it as well. Even so, there's been a lot of uncertainty across the GCC when VAT has been implemented. In the UAE, for example, the experience has been that the authorities there accept that the tourist fee and the municipality charges are not subject to VAT. In other words, they're arguing that they're being collected on the guest and just being collected by the hotel. But the service charge, however, is subject to VAT because that's something that the hotel operator applies to the bill, or maybe at a restaurant if there's a service charge, and so on. So that does form part of the supply and is subject to VAT. Abba mentioned vouchers. As she said, we expect that there are two types of vouchers, and the time of supply depends on what type of voucher is being issued. So a single purpose voucher is one where the place and the value is known when the voucher is issued. It's likely to include a voucher for one night's accommodation at a particular hotel, or a cinema voucher, which is to see a film at a particular venue, at a particular time, on a particular day. So that's generally a single purpose voucher. Whereas other types of vouchers, a multi-purpose voucher, is one where the value can be used to purchase a whole range of goods or services at any time. So the rule here basically is, if it's a sale of a single purpose voucher, then VAT is applicable at the time of sale, just like selling any other good or service. Whereas if it's a multi-purpose voucher, then VAT is not accounted at the time the voucher is sold, but later when it's redeemed for goods and services by whoever is supplying those goods and services, which could be someone different to the person who has provided the voucher. If we look at travel packages, so if you're a travel agent, you might be putting together a tour package for either a resident or, say, a non-resident. It might include international airfares, airport pickup, perhaps by a private limousine, domestic bus travel, which is likely to be by a private operator rather than some public operator, the hotel accommodation. There might be a local Muscat City tour that's included, and then there's your agency fees for arranging the package. So as an agent, you might collect the money for the full package. So apart from determining what parts of the package are standard or zero rated, if any, do you need to report VAT on the total consideration in your return? Or again, only those services which are being actually supplied by you as an agent, namely just the commission that's earned. So this can depend on whether you're acting as a disclosed or an undisclosed agent, as we mentioned earlier. But if we go back to the package, can you zero rate some components, such as the international airfare? We know that local transport is potentially likely to be either taxable or exempt, depending on whether it's public or not public. So these are some of the issues that a travel agent will need to work through in conjunction with the brief comments in the law and what the regulations set out. But we're hopeful that there will be a guide that will help us understand a lot of the issues in finer detail. Advance payments. So an advance payment will trigger the time of supply, even though you've not invoiced someone for the supply, or you might not have yet been paid for the supply. So an example of this could be someone could book a conference facility at a hotel. They might do this something like 6 months in advance. So what about the different payment methods that you might take? You might take a credit card guarantee rather than actual payment of cash. So generally a credit card guarantee is not treated as consideration for a supply. So it's not considered as an advance payment. So it may not trigger your liability for VAT if you just take a credit card guarantee. You might charge an amount to the credit card as a hold or a security, and it is clearly refundable at the end of the person's stay. So this may be treated as a refundable deposit, and again, no VAT obligations would arise if that's the case. You might have a credit card and you're holding it as a guarantee, but there's a no-show or there's a cancellation. And at that point, you charge the credit card. So generally that's considered as being subject to VAT. It's not a penalty, which might be treated as out of scope, but it's actually consideration for a supply. Yes, you did not supply the accommodation or you didn't supply the cinema ticket, but generally the authorities consider that what you have supplied is the right to those things, and that's taxable. If, for example, there's some sort of charge for property damage that someone might cause during their stay at a hotel, that clearly has all the characteristics of being punitive in nature and will be treated as being out of scope. We have a look at the VAT treatment for long-term hotel stays. So we know that hotel accommodation is taxable at the standard rate of 5%. We know that residential accommodation is to be exempt. And in some VAT regimes, once your stay in a hotel exceeds a certain number of consecutive days, the accommodation changes from being taxable to being treated as if it's residential and therefore exempt. So we'll need to have a close look at the regulations as to whether they specify any sort of time period, if any, when it comes to a long stay in a hotel or serviced apartment. So that's something that you need to have a close look at. A lot of hospitality businesses these days operate loyalty programs. I've got heaps of cards and memberships to different loyalty programs. As a general rule, they're free, so there's no VAT. But if there was a charge to join, a nominal charge of a couple of reals, then that would be subject to VAT. That's a supply of a service. The actual issuing of loyalty points generally is not considered as a separate supply. You stay a night at a hotel, you pay for the night's accommodation, and you get given some points credited to your account. That's not regarded as a separate supply. That's all part of the single supply of the accommodation for which you've paid the consideration. Each point in a scheme generally has a particular value, a cash value to it. And it's usually the redemption of the points that is treated as consideration for the supply. And the VAT is payable on the value of the supply made at the time of redemption by the person who's supplying the goods or services. Now, if the hotel or the cinema or the business is part of a scheme, there's a scheme operator and you're a partner and there are fees involved, then those fees would normally be subject to VAT. If we look at promotions, promotions is something that's used often as a marketing tool. So promotions need to be carefully considered to make sure that you're not triggering a deemed supply. You're not giving something for free for no consideration. If you're advertising, say, stay 7 nights, pay for 5, well, that's not going to trigger a deemed supply on 2 nights accommodation. That's just a discount that you're giving on 7 nights accommodation. You might have a promotion, buy 1 cinema ticket, get 1 free. Again, that is just, you're getting consideration for 1 ticket, or for 2 tickets, which just happens to equal the price of a single ticket. Ideally, in these marketing campaigns, you should try to avoid using the word free because, as I said, that's likely to attract the notice of the tax authorities. They might be asking questions about, well, is this actually part of a single promotion or is it a potential deemed supply? So it's something you just need to be careful about in terms of the marketing approach that you adopt. If we look at employee benefits, so businesses provide employees with all types of benefits. Some are required under respective labour laws, some are agreed in particular employment contracts. In the other GCC VAT states, they often allow such benefits without triggering a deemed supply, provided it's normal business practice in the industry. And again, we're going to probably need to wait until some guidance comes out because this largely is a matter of interpretation by the Oman authorities. If you provide cash payments to employees, say a cash bonus or a cash award, it's out of scope. There's no VAT. If you provide benefits in kind, say a gift basket, then this is likely to trigger a deemed supply subject to certain thresholds. Those thresholds are likely to be quite low. The regulations are likely to include a threshold per person per year, as well as a total for the business as a whole. And as I said, based on experience elsewhere, those thresholds are very, very low. So it's likely that most businesses will breach them. If you give employees a discount, then provided the same discount is available in the market to the public in general, it will not trigger related party valuation rules where you need to assess VAT not on the consideration actually charged, the discount, but on the market value. Providing meals to employees may or may not be treated as deemed supply. Again, we just have to wait for the guidance from the authorities on that. If you're providing rental accommodation, it won't trigger a deemed supply because it's an exempt supply. So the acquisition of the accommodation will not have had any input credit and therefore there's nothing to claim and therefore it won't trigger a deemed supply arrangement. Abba already mentioned that there'll be some expenses which will be blocked even if they're used for business purposes. So it's business entertainment, it's catering services, it's motor vehicles for private use. So they're the things that are generally going to be blocked. And the regulations will give us some more specific details around those. Transitional contracts. Again, this is to do with advanced bookings that you might take. It's not uncommon in your industry for there to be a lot of advanced bookings that you've taken. So again, in this case, if the supply is going to be made after 16 April, it's going to attract VAT. So you might have taken a conference booking 12 months ago. It might have been paid for in part or full. If it's delivered after the 16th of April, it's going to all be subject to VAT. So you need to be very, very careful about those sorts of arrangements. Abba mentioned the supply of local passenger transport being exempt. What we need to be careful about is having a look at how broad that definition is. How will it be defined? We expect that it's going to be limited to scheduled public transport and bus transport and domestic airfares and public taxis. And it's not likely to cover private limousine services offered by hotels and so on, or even extend to rideshare businesses, which to some extent is good because if it is exempt, then it does impact on the recovery of VAT. Whereas if it's taxable and all of your business is making taxable supplies, that makes life a lot easier for you. Zero rated food. So as Abba mentioned, there's a list of some 90 odd food items that are going to be zero rated. It includes fresh meat, vegetables, water, coffee. So importantly, while the supplier may supply these to your restaurant at a zero rate, when you use these to prepare and serve a meal, the entire meal will be taxable. It's not a case of you being able to break it up into separate supplies of food and a restaurant service. It's all taxable. But if the same food item was supplied separately in a supermarket that might be, say, located in a hotel, then that can still be zero rated. Aber also mentioned the reverse charge. So as a general rule, the supplier has the obligation to account for VAT on their supply, if any. But where a registered recipient in Oman receives services from a non-resident, then the VAT is reversed. The recipient needs to account for it. You as a business receiving that service from a non-resident need to account for VAT to the extent that you're eligible to do so. And you can normally do that in exactly the same VAT return that you account for the VAT. So it's just a book entry. It's VAT payable, VAT recoverable, no actual cash flow impact. But it is really important that you capture these transactions and you report them on your VAT return. It can apply to where you're paying royalties to an overseas partner, or maybe there are supplies of agency service by a non-resident in an overseas market. All of those things are likely to be reverse charged. And this can present quite a challenge for your accounting systems and processes, which are normally geared to treating such invoices as an accounts payable rather than both an accounts payable and an accounts receivable. So having mentioned the word accounting processes, I'm happy now to pass you on to Julie, who's going to look at some of the IT functions that you need to consider in preparing for the VAT.
Thank you, Rob. So indeed, I will take maybe just 5 minutes to give you some pointers and some ideas of what do you need to consider in the coming month, just to make sure that you are ready to issue your invoices and to be able to cope with the VAT charged to you once Oman goes live with VAT. So what you see on the slide is the sort of the full IT landscape of a typical company with sales and purchase processes that are all impacted by VAT. So obviously, I will not go into all the details, but I just want to give you a couple of ideas of what is there that you can do that is essential for you to be able to handle VAT efficiently. It all starts and either works or fails depending on the master data that you have in the system. Whereas on your customer side, you in your industry, it would very often be a private individual, and you would maybe not capture all of their details. On the vendor side, you actually want to be sure that the vendor, if they're charging you VAT, they are charging VAT correctly, or if it's a foreign vendor, that you're actually able to apply reverse charge, as Rob just explained. So you do need to review your master data to be sure that if your supplier is already registered for VAT, that you actually capture their VAT registration number to know once they send you the invoice on the 16th of April, that you can verify, are they applying that VAT correctly? Are they actually registered? And on that, actually, Oman has deviated from what we've seen in other countries in GCC, where the VAT registration numbers were just numeric. Oman has an alphanumeric VAT registration number sequence, which basically contains, it starts with OM being alpha, and then it has 10 digits, but what we've seen also that in some cases, the last position is not a number, but again, a letter. So you need to have the flexibility in your system to accommodate for such a complex number. So that's something to really look into, because that from my experience, I can say that this might pose some challenges. And even if you are operating in, say, UAE or KSA, this is different than from what your system is used to. So definitely something to look at. If we look at the setup of the tax codes, then definitely, especially on the purchasing side, you will be confronted with all the different variations, because you will have obviously the 5% purchases, but given that a lot of you will be purchasing food items for further preparation of meals and other type of catering and everything, you will be purchasing zero-rated food items as well. You will probably have reverse charge. So that means that you do need to be able to manage all these differences. So your system needs to be able to cope with that. We've mentioned import VAT, that probably will first be payment at the entry point, but maybe also can be reverse charged under conditions. So again, here you would also need to be able to cope with different treatments, and your system needs to already be set up to have all these variations, because setting up a tax code probably sounds simple, but often you need to go through the whole chain of change requests in order to accommodate for that, and that requires time. So now that you're working on the system, make sure that you have all the variances that you might need, because that will make it easier. If some code will not be used, then it will just be sitting in the system. It's rather that it's there and present and ready for you to use than needing a lead time to create a new code. And one last point that I want to touch upon, so that we also leave some time for Q&A, is the invoice forms. This is really important to be sure that your invoice formats are updated to be able to accommodate for VAT, not only from the perspective of showing the VAT on the invoice, but with VAT regulations, you will need to accommodate for other mandatory fields on your invoice that you might not use at the moment. So this can be updating your own header data to include your tax registration number. It can be showing the line items in a certain format to accommodate, to show what is your unit price, what is your VAT rate applicable. So all of these details, they are there in the executive regulations, and that is something that you would need to look at to make sure that your invoice from the format perspective looks compliant. And last thing that I want to mention is that you need to make sure that all of your invoice formats that you're using are updated accordingly to prevent that people still use old formats that are not VAT compliant going forward, because we've seen it in other countries that if that format is not blocked for use, people will still accidentally use it, and hence you will issue non-compliant invoices, which will be and the penal implication for you in the event of audit. But also, if your customer is another business, they would want to recover this VAT, and you want to make sure that they are actually eligible to recover based on your compliant invoice. So with that, I pass it back to Abba for the next steps.
Thanks, Julie. So I think the message is consistent. VAT impacts all facets of your business. It's not just a tax or a finance project. It is a business transformation project. and businesses need to look at every part of their operation to be VAT ready. And this can only be done by working collectively and not in silos. So with 1 day to go for registrations, 31 days for go live, and 138 days for the first return, it's important that you prioritize, focus on the mission critical items, understand your registration obligations, know your registration options, VAT group or independent registration, voluntary registration, weigh the pros and cons, and register in time, because if you fail to register in time, you could attract penalties. VAT is a transaction tax, so assess every transaction, purchase as well as supply, and understand the tax treatment on every transaction. Apply for exceptions if you're eligible. Review your contracts to make sure that you have the right to recover VAT if VAT is chargeable. VAT is not intended to be a cost to business, but in the absence of a VAT recovery clause, it could be. Understand the impact on IT, configure and test systems in time, and have a plan, have a cutover strategy. Transition to VAT generally requires careful planning, and having to transition in the middle of a month only adds to the complexity. And train your team, train or educate your customers, educate your vendors, because you have vested interest. And finally, go live. But that's not where it ends. It just begins there. There will be clarifications issued after the 16th of April. You may need to reassess your tax positions. You may need to revisit the system configurations. So stay agile. With that, we can close the presentation and we can move on to the Q&A. Thank you all.
Thank you, Abba and team. Let's now look at the questions that have come from the attendees. The first question, possibly, Abba, I would sort of give it to you. This is a general question dealing with simplified invoices. The question is, do we need to get an approval to issue simplified invoices from the point of sales systems? This is in context where the regulations, according to the participant, provides an option to issue a simplified tax invoice with lesser contents, subject to the prior approval of the Oman Tax Authority.
Sure. So yes, the participant is right that in order to, so there is an option to issue simplified tax invoices, but that's only in certain circumstances. If you qualify for issuing simplified tax invoices, you need to make an application to the tax authority. The tax authority needs to approve your application before you can start issuing simplified invoices. This is a time-bound process. If the tax authority does not respond to your application or does not approve your application within the time specified, then your application could be deemed to have been rejected.
Okay. The next question is for Rob. How is the profit, that is markup, I believe, on visa fees treated? So this is probably a tour operator who arranges for visas for his clients. And apart from paying the government visa fees, there is a profit markup. So the question is, how do you treat the profit, assuming according to him that the government visa fee will not be covered under the VAT umbrella?
Thank you, Ashok. So yes, there's still the issue of whether or not the government will charge any VAT on their visa issuing. That's still unclear. However, in most jurisdictions, when the government's acting in a sovereign capacity, they do not charge VAT. So in other jurisdictions, there would be no VAT on the visa. But the visa is being paid on behalf of someone, and therefore, when you seek to recover the visa costs, that's a disbursement. There'll be no VAT on the recovery of the visa costs. But if you add a markup or if you have a charge, a service charge for performing this service for your particular client, that will be subject to VAT. So you will need to account for VAT on the profit markup that you add.
Okay. This question I could pose to Julie. The question is, can we take full credit for input VAT paid on food material costs? These are used for provision of catering services and also consumed by the company's employees. Provision of food and accommodation are as per the employment contracts.
Yeah, so obviously, where you will use the materials for your business, that should be recoverable. But as I think both Abba and Rob have mentioned, there is a certain there are certain provisions in the law that say that where there is a private use, that should be considered as blocked expense. So with these kind of elements where you purchase raw materials and some of that might be used for personal use, obviously it becomes quite complex. And what we've seen is depending on country, the conditions are different. For example, Bahrain has introduced sort of a percentage, a simplification to say that this is the percentage for these type of expenses that you can use. And obviously you would need to see if in certain cases the provision of food to your employees is a legal obligation because of their working shifts and schedules, then that would be considered your business expense because you didn't choose to do so, but the law prescribes that you provide the food. So depending on the exact situation, you would need to assess how to handle this situation.
Right. Thank you, Julie. The participant has asked a similar question on vehicle lease charges, where the vehicles are used for transportation of goods and employees. This is with reference to trucks and vans, and also for the daily use of employees, that is cars. I presume the same response will apply.
Yes. Yes.
Okay.
I think the only addition that we'd like to make for motor vehicles is that even if these are made available for use by employees for personal use, not actually used, but made available for use, you could be, the input tax recovery on these expenses could be disallowed.
Yeah. Rob, this question for you. Will VAT be applicable on commission charged by Agoda, Booking.com, etc.? These agencies reimburse on a net payment basis after deducting commission. The question is, will VAT be calculated on the gross bill or the net bill?
So, firstly, VAT is going to be payable insofar as these Booking.com and so on, usually the contract is with someone who is outside of Oman. So it's usually a non-resident who is supplying the platform and the advertising on their website, say Booking.com or some such. So the charges that they make to you for their commission is going to likely be a reverse charge. It is a supply of a service from a non-resident to someone who's registered in Oman. So you'll need to apply the reverse charge to the extent of the commission that they retain. The balance of the funds, well, that's just them collecting money from your customer and providing the money to you. So that's generally a disbursement. So I would expect that you would need to reverse charge the commission element only.
Okay, this is a last question. In fact, two questions for Abba. One is with reference to a local destination management company. So I think attendee is from a destination management company. The question is, would such a company that buys locally and sells only to overseas buyers, do they need to pay VAT? And the second question, Abba, if you don't mind, is not related to this, but the question is, are we aware of the conditions for issuing simplified invoices?
Okay, so let me get the first question on the destination management company. If you're a local business that purchases locally and supplies only to overseas customers, you need to look at your VAT registration obligations. As I mentioned earlier, you need to obtain registration mandatorily if the value of your supplies over 12 months exceeds 38,500 Omani Riyals. In order to ascertain or arrive upon that 38,500 Omani Riyals, you need to look at standard rated supplies as well as zero rated supplies. You also need to look at any purchases that you make that are liable to VAT under reverse charge. But in your case, since you're purchasing locally, that perhaps is not, that is of limited relevance. So if your supplies qualify as exports or qualify as standard rated, your turnover is in excess of 38,500, you would be required to register for VAT. If all your supplies are zero rated, you can apply for an exemption from registration and therefore not have to charge or not have to have VAT obligations. But there is a specific process to it, and you would need to look at whether you want to do that or not, because as a local business, as a business that is purchasing locally, your vendor is going to charge you VAT. If you're not registered, you're not going to be able to avail the input tax credit or claim a refund of these VAT costs incurred on the purchases. So you need to look at registration obligations, and you need to make an informed decision on whether you want to forego registration and therefore forego the input VAT recovery. On the second question on what is likely to be the condition for simplified tax invoices, a preliminary assessment of the executive regulation suggests that this will be based on the value of supplies. If the value of supply is under a certain monetary threshold, and in that case, you may be eligible to issue a simplified tax invoice.
Okay, thank you, Abba and team. Thank you, participants, for joining and actively participating with all your questions and answers. Needless to say, the KPMG team is there to support you during the next 30 days as you get ready for the Go VAT Live date, and thereafter for any assistance that you may require in engaging with the tax authority. So thank you all once again for joining us. Bye-bye.
Thank you all.
Thank
Have a
you.
good day.